If you've been anywhere near the financial markets lately, you already know the emotional punishment we've all been subjected to. But here's what nobody is telling you. Right now, on May 4th, 2026, while the average retail investor is panicking and selling at a loss, the smartest money on the planet is quietly doing the exact opposite. And by the end of this video, you are going to understand exactly why. Let's be brutally honest about what happened. Early 2026 was a psychological war zone for silver investors. We watched silver go completely parabolic, screaming up to that jaw-dropping $121.69 intraday high in late January. The euphoria was unlike anything this market had seen in decades. Social media was exploding. Everyone was a genius. And then, without warning, the floor simply disappeared. A savage, unforgiving reversal sent the spot price crashing violently down to $66. Not a dip, a massacre. Forums erupted in despair. People who had leveraged positions were wiped out overnight. The weak hands didn't just sell, they ran, and they swore they would never touch silver again. But here is the critical question you need to ask yourself right now. Were those people reading the market correctly, or were they reacting to pain instead of data? Because if you are looking at silver consolidating in the low 80s today and feeling nervous, you are not reading the board correctly. You are confusing the end of a chapter for the end of the book, and that distinction is going to cost you everything. Let me give you some mathematical context. When an asset rises 147% in a single year, the way silver did across 2025 and then spikes another 60% in just a matter of weeks on top of that, a correction isn't merely possible. It is mathematically programmed into the system. It has to happen. Macro strategist David Hunter called this perfectly. He warned that when bullish sentiment reaches a fever pitch, the market is engineered to clear the deck. He initially projected a sharp 35% pullback following the January parabolic spike. The actual drawdown ended up being closer to 50%, slamming into the mid-60s during that brutal overnight session. But here is what the panicking retail crowd missed entirely. That violent shakeout wasn't a failure of the bull case. It was the bull case executing its most important function, redistribution, eliminating the over-leveraged speculators, transferring silver from weak emotional hands into strong, patient, institutional ones. The smart money operating at the highest level does not care about daily spot price fluctuations. They are watching a macro environment where traditional financial hedges are being completely reevaluated. They are watching global debt expand at a pace that has no historical parallel. And they are methodically positioning themselves for a fundamental revaluation of tangible, real-world assets. The retail investor looks at the chart and sees danger. The institutional investor looks at the same chart and sees a loading screen. Now let's move past the psychology and get into the physical reality. Because the physical reality of the silver market in 2026 is not whispering, it is screaming. On April 15th, 2026, the Silver Institute and Metals Focus released the World Silver Survey 2026. This is the most authoritative annual report on the global silver market. And if you hold physical silver or silver mining stocks, this document handed you the entire bull case on a silver platter. Here are the facts that cannot be argued with. The sixth consecutive deficit. The global silver market is projecting a supply deficit of 46.3 million troy ounces for 2026 alone. That is a 15% widening of the shortfall compared to 2025. We are now entering our sixth straight year where total global demand has exceeded everything miners can pull out of the ground. The Great Drain. Since this deficit cycle first began back in 2021, a staggering 762 million troy ounces have been drawn down from above-ground silver stockpiles just to cover the gap between what the world needs and what actually gets produced. There is no modern precedent for this level of sustained, relentless inventory depletion. None. Supply is actually shrinking. Despite silver prices being dramatically higher than they were just a few years ago, mine production is completely stagnant. Total global silver supply is actually forecast to decline by 2% in 2026. The reason is structural. Years of severe underinvestment in exploration, combined with the reality that approximately 70% of all silver produced globally is a byproduct of mining other base metals like zinc, lead, and copper, means you simply cannot turn on a tap and produce more silver on demand. The supply side of this equation is essentially frozen. Industrial demand is inelastic. Yes, there's been a modest dip in overall demand due to price rationing in the jewelry sector, particularly across India, but industrial demand remains an absolute beast that refuses to slow down. The explosive global expansion of AI-driven data centers, electric vehicles, and solar photovoltaic installations all require silver in substantial quantities. Silver is the single most electrically conductive element on Earth. You cannot substitute it without directly sacrificing performance. These industries are not slowing down, they are accelerating. Here is the bottom line on the fundamentals. The paper futures market is pushing the spot price lower right now based on dollar strength and shifting geopolitical calculations around the Middle East ceasefire negotiations. But the physical silver market is structurally tighter today than it was when silver was trading at $30 an ounce. The deficit is the thesis. Everything else is noise. A 35% price discount from the January high on an asset with fundamentally worsening supply metrics is not a warning signal. It is a gift. We absolutely cannot discuss the 2026 silver market without addressing the massive geopolitical earthquakes that have completely transformed the landscape over the past 6 months. In November 2025, the United States officially designated silver as a critical mineral for the very first time in American history. Let that sink in for a moment. This was not a routine bureaucratic update. This was a national security declaration, a formal acknowledgement that silver is now essential to America's energy transition, its defense supply chains, and its strategic industrial competitiveness. Then, in January 2026, China moved with stunning speed. Beijing implemented sweeping export controls on silver, formally reclassifying it as a resource vital to Chinese national interests. China, which produces approximately 14% of global silver supply, essentially locked the door on a meaningful portion of world output. Consider the profound gravity of what just happened. The two largest economic superpowers on the planet, two nations locked in an increasingly intense strategic rivalry, have both simultaneously and formally recognized that silver is no longer simply a precious metal for jewelry or a fringe monetary hedge for doomsday preppers. It is now a critical strategic industrial asset in a world that is electrifying at an unprecedented pace. When governments of that magnitude step in to lock down supply chains of any commodity, one outcome becomes inevitable. The era of cheap, easily accessible silver is over permanently. To understand the timeline of exactly how this plays out from here, we need to examine the work of macro strategist David Hunter, who has been remarkably prescient about the trajectory of this entire cycle. Coming into 2026, Hunter had established a price target of $125 per ounce for silver. When that catastrophic sell-off down to $66 materialized, Hunter did not retreat. He did not revise his thesis downward the way most analysts scramble to do after being caught off guard. Instead, he carefully examined the underlying momentum, assessed the severity of the weak hand shakeout, weighed the systemic pressures building in the global financial system, and he raised his silver target to $180 per ounce. Simultaneously, after the correction cleared out speculative froth from the gold market, he raised his gold target to $6,800 per ounce. Why would any rational analyst raise a target after a 50% drawdown? Because the drawdown didn't weaken the thesis. It strengthened it. Every ounce of silver that moved from a panicking retail investor into the hands of a patient institutional accumulator made the eventual price reckoning more violent, not less. We are currently navigating what Hunter describes as the final stretch of a decade-long macro cycle. Over the next 5 to 8 months, the market is actively engineering the conditions necessary for a final, historic inflationary melt-up. The Federal Reserve is trapped in a position with no clean exit. Elevated crude oil prices, currently hovering near $109 per barrel for Brent crude due to ongoing disruptions in the Strait of Hormuz, are sustaining sticky, persistent inflation that refuses to surrender. Hunter believes this summer or early fall will produce the steepest and most violent rally of this entire bull market. Moving from $80 to $180 is obviously a massive and audacious move, but in a market already defined by extreme volatility, chronic physical supply deficits, and the potential for industrial demand squeezes, a doubling of the price is not just possible. Based on the structural mechanics of this market, it may actually be conservative. We are climbing the classic wall of worry that every major asset must scale before achieving a true parabolic peak. The pain you feel during the climb is precisely what makes the peak possible. Now I need to be completely candid with you because this is the part of the story where most financial content creators go silent, and it is the most important part of the entire analysis. This is not a buy and hold forever scenario. Hunter's framework does not end with silver at $180 and everyone living happily ever after. His complete forecast includes a prediction that this spectacular melt-up in precious metals and broader risk assets will culminate sometime in late 2026. Following that peak, Hunter foresees a global macroeconomic bust centered in 2027. A deflationary contraction that he believes will be materially worse than the 2008 through 2009 Great Financial Crisis. During this bust, virtually all asset classes outside of U.S. Treasury bonds will take catastrophic hits. The S&P 500, which Hunter projects could reach a peak of 10,000 during the melt-up, could subsequently crash 70 to 80%, potentially falling all the way to the 2,000 level. Oil, which may already begin rolling over before then, could plunge from current levels down to $30 per barrel as global industrial demand completely evaporates. And precious metals will not be immune. Because silver carries significant industrial exposure on top of its monetary characteristics, it could drop 60 to 70% from its 2026 peak during the depths of the 2027 deflationary bust. Gold, being more purely monetary, might decline 30 to 50%. This is not a comfortable message, but it is an honest one. If you are a passive investor operating on autopilot with a pure buy and hold mindset, the coming years are going to inflict serious damage. The strategy that worked beautifully in broad index funds for 4 decades is about to walk directly into a buzzsaw, riding out an 80% drawdown Mathematica.